All content provided by the rational investor is for educational and informational purposes only. It is based on academic principles in philosophy, psychology, and behavioral finance. We are not registered financial advisors. Nothing on this channel constitutes financial advice, investment recommendations, or an endorsement to buy or sell any security. Consult a qualified, registered financial professional before making any investment decisions. By watching our content, you agree to hold the rational investor harmless from any losses or damages resulting from your investment choices. If this approach to blending Stoic discipline with financial strategy resonates with you, I warmly invite you to join our community. Hit that subscribe button to get weekly documentaries that empower you to navigate markets with clarity and fortitude. For more on tackling cognitive biases, check out our playlist on Stoic investing principles, linked below. Let's keep building your portfolio strength together, one rational decision at a time.
Investment choices. What if I told you that the first number you see when evaluating an investment, the purchase price, the analyst target, the 52-week high, is sabotaging every valuation decision you make afterward? This is not conjecture. This is the anchoring effect, one of the most pervasive and expensive cognitive biases in behavioral finance. Anchoring occurs when an irrelevant initial value disproportionately influences subsequent judgment, causing you to make irrational adjustments from an arbitrary starting point rather than reasoning from fundamental value. You buy a stock at $80. It falls to $60. Your brain anchors to $80, interpreting $60 as cheap regardless of whether the company's intrinsic value is $40 or $100. The Stoic philosopher Epictetus understood this psychological trap 2,000 years before Daniel Kahneman formalized it in academic research. His core teaching, distinguish between impressions and reality, between appearance and true nature, provides the only systematic method to overcome anchoring by training your mind to focus exclusively on intrinsic value. In this documentary, I will give you the Epictetus tactic, a 4-step framework that neutralizes anchoring by anchoring your analysis to fundamentals rather than to arbitrary price points. This is not theory. This is operational discipline for investors who refuse to let irrelevant numbers hijack rational valuation. Part 1. Let me show you exactly what the anchoring effect is and how it's costing you money on every single trade. The anchoring effect is a cognitive bias where the first piece of information encountered, the anchor, serves as a reference point that disproportionately influences all subsequent judgments, even when that initial information is arbitrary, outdated, or irrelevant. This bias was first rigorously documented by Amos Tversky and Daniel Kahneman in 1974 through a series of experiments that demonstrated the power of irrelevant anchors to distort rational judgment. In their most famous experiment, they asked participants to estimate the percentage of African nations in the United Nations. Before answering, participants watched a wheel of fortune spin and land on 10 or 65. The participants who saw the wheel land on 10 estimated an average of 25%. Those who saw 65 estimated an average of 45%. The wheel was random. The participants knew it was random, yet it anchored their subsequent estimates by 20 percentage points. This is not a minor adjustment. This is the wholesale hijacking of judgment by irrelevant information. The psychological mechanism operates through what Kahneman calls the anchoring and adjustment heuristic. When your System 1, the fast, automatic, intuitive processor, encounters an anchor, it treats that number as a provisional answer. System 2, the slow, deliberate, analytical processor, is then supposed to adjust away from the anchor, toward the correct answer. But System 2 is lazy. It is metabolically expensive to operate. So instead of reasoning from first principles, System 2 makes insufficient adjustments from the anchor, producing answers that remain systematically biased toward the initial reference point. You buy a stock at $80. It declines to $70. Your brain does not ask, what is this company worth? Your brain asks, how far is 70 from 100? The $30 decline feels like a loss, so you hold, waiting for the stock to get back to 100. But 100 is arbitrary. It is simply the price at which you happen to enter. It has no relation to intrinsic value. The company could be 50 or 150. Your anchoring to 100 prevents you from making this assessment. 52-week high anchoring is equally destructive. A stock trades at $150. It declines to $90. Financial media describes it as down 40% from its high. Your System 1 interprets this as cheap because it's far below the anchor of 150. You buy at 90, reasoning that the stock will recover. But the 52-week high is arbitrary. It may have been the peak of irrational exuberance. The stock may be overvalued at 90, but anchoring to 150 creates the illusion of value where none exists. Analyst price target anchoring introduces external anchors into your process. An analyst publishes a price target of $120. The stock currently trades at $90. Your brain latches onto 120 as the fair value, and 90 feels like a discount. But the analyst's target is not a fundamental calculation. It is often a politically motivated number designed to generate trading commissions or maintain investment banking relationships. Yet once your brain has anchored to 120, all subsequent analysis is biased toward justifying that target rather than independently deriving intrinsic value.
Historical average valuation anchoring affects entire asset classes. Investors observe that the S&P 500 has historically traded at a price-to-earnings ratio of 16. The current ratio is 22. They conclude the market is expensive and wait for it to revert to the mean. But 16 is not a law of nature. It is an average across multiple economic regimes with different interest rates, growth rates, and inflation environments. Anchoring to historical averages prevents you from assessing whether current valuations are justified by current fundamentals. You end up out of the market during secular bull runs because you are anchored to an irrelevant historical reference point. The aggregate cost of anchoring is difficult to quantify precisely because it operates at the level of individual decisions, but the research is damning. A study by Northcraft and Neal showed that even professional real estate agents, experts who should be immune to irrelevant anchors, had their property valuations influenced by listing prices by an average of 12%. If professionals with years of training cannot resist anchoring, retail investors operating without systematic discipline have no chance. Every anchored decision biases your portfolio toward suboptimal holdings, and these biases compound over years into significantly lower terminal wealth. This is where Epictetus enters the conversation with a solution that is both ancient and urgently modern. Epictetus was born a slave in Hierapolis around 50 AD and spent his early life in bondage to Epaphroditus, a wealthy freedman in Nero's court. Despite, or perhaps because of, his experience of powerlessness, Epictetus developed a philosophy centered on identifying and controlling the only thing truly within human power: judgment. After gaining his freedom, he established a school in Nicopolis, where he taught Stoicism to students who came from across the Roman Empire. His teachings, preserved by his student Arrian in the Enchiridion and Discourses, revolve around a core principle: distinguish between your impressions and reality itself. Epictetus writes in the Enchiridion, "It is not things themselves that disturb people, but their judgments about those things." A stock price declining from 100 to 70 is a thing, a market transaction reflecting the aggregate judgment of buyers and sellers at a moment in time. Your judgment that 70 is cheap because it is below 100 is not a thing. It is an interpretation, an impression that your mind has generated by anchoring to 100. Epictetus would argue that this impression should not be assented to automatically. It should be tested against reality. The Stoic technical term for this testing process is phantasia catalepticae, a cognitive impression that can be grasped with certainty because it corresponds to reality. Not all impressions meet this standard. Most impressions are phantasia acataleptis, impressions that cannot be grasped with certainty because they are based on appearance rather than essence. When you form the impression, "This stock is cheap at 70, you must ask, is this impression based on the intrinsic characteristics of the company, its cash flows, competitive position, management quality, or is it based on an arbitrary reference point like my purchase price? The connection to the anchoring effect is profound and direct. Anchoring is the failure to distinguish between appearance and reality. The anchor, whether it is a purchase price, a 52-week high, or an analyst target, is an appearance. It is a number that exists in your perceptual field, but has no necessary relationship to the underlying economic reality of the business. Intrinsic value is reality. It is the present value of all future cash flows that the business will generate, discounted at an appropriate rate. This value exists independent of what price you paid, what price the stock reached last year, or what an analyst believes it should reach. Epictetus taught that the path to eudaimonia, human flourishing, requires training your prohairesis, your faculty of choice, to assent only to impressions that correspond to reality. In investment terms, this means training yourself to assent only to valuations that correspond to intrinsic value, not to valuations that are psychologically comfortable because they confirm your anchor. This is not easy. System 1 generates anchored impressions automatically. It takes disciplined practice to engage System 2 long enough to override the anchor and reason from fundamentals. The Stoics believed that this practice must be daily. Marcus Aurelius wrote in Meditations that every morning he reminded himself that he would encounter liars, cheats, and ingrates, not to be cynical, but to be prepared. This is the Stoic practice of premeditatio, preparing your mind in advance for the distortions you will encounter. In investment terms, you must prepare your mind in advance for the anchors you will encounter. You will see your purchase price. You will see the 52-week high. You will see analyst targets. These anchors will generate impressions. Your responsibility is not to be free of impressions. That is impossible. Your responsibility is to recognize them as impressions and test them against intrinsic value before assenting. Epictetus also taught the dichotomy of control, which applies powerfully to anchoring. The price at which you purchased a stock is outside your control. It is a historical fact that cannot be changed. The 52-week high is outside your control. It reflects market sentiment at a different time under different conditions. Analyst targets are outside your control. They reflect someone else's judgment, which may be brilliant or idiotic. What is within your control is your current valuation process. You control which metrics you analyze. You control whether you calculate discounted cash flow or rely on price-based heuristics. You control whether you seek disconfirming evidence or simply confirm your anchor. By focusing exclusively on what is within your control, the rigor of your valuation, you immunize yourself against the irrelevant anchors that dominate what is outside your control.
Philosophical insight here is that anchoring represents a fundamental confusion about what should command your attention. When you anchor to a purchase price, you are allowing a past decision made with incomplete information under different market conditions to dominate a present decision that should be made with complete information under current conditions. Epictetus would call this living in the past rather than living in accordance with nature. Nature demands that you respond to reality as it is, not as it was. Intrinsic value reflects reality as it is. Anchors reflect reality as it was, or as others believe it should be, or as you wish it to be. The Stoic investor trains their mind to distinguish between these categories without mercy. Part 3. Let me give you the exact 4-step Epictetus tactic to neutralize anchoring and focus on intrinsic value. We have established what anchoring is and why Epictetus's emphasis on distinguishing appearance from reality provides the philosophical foundation for overcoming it. Now I will give you the operational framework, the Epictetus tactic, a 4-step systematic process that neutralizes anchoring by forcing your analysis to begin with intrinsic value rather than with arbitrary reference points. This is not abstract philosophy. This is a concrete protocol you can implement immediately on every investment decision you make. Step 1. The anchor purge. Eliminate all reference points before beginning analysis. The first step in the Epictetus tactic is the most counterintuitive, but also the most critical. Before you analyze any investment, you must systematically purge your mind of all potential anchors. This requires deliberate effort because anchors embed themselves automatically. You cannot simply decide, "I will not be influenced by anchors." You must create a procedural barrier that prevents anchors from entering your analysis in the first place. Here is the protocol. When you are evaluating a new investment, do not, under any circumstances, look at the current stock price, the historical price chart, the 52-week high or low, or analyst price targets before you complete your intrinsic valuation. This seems impossible to most investors. Price is the first thing everyone checks, but that is exactly why anchoring is so pervasive. By checking price first, you contaminate your entire subsequent analysis. Instead, you begin with the company's financial statements. You download the past 5 years of income statements, balance sheets, and cash flow statements. You review the annual report's management discussion and analysis. You examine the business description to understand revenue sources and competitive positioning. You examine margins, returns on capital, and cash conversion cycles. You build your discounted cash flow model, estimate future growth rates based on historical performance and industry dynamics, select an appropriate discount rate based on the company's cost of capital, and calculate a per-share intrinsic value. Only after you have written down your intrinsic value estimate and committed to it in writing do you allow yourself to look at the current market price. The psychological power of this sequence is profound. When you calculate intrinsic value before seeing price, you are forcing System 2 to engage with fundamentals without the distraction of anchors. Your analysis is pure. It reflects your genuine assessment of the business's ability to generate cash flows. When you then compare your intrinsic value to the market price, you can make a rational decision. If intrinsic value is substantially higher than market price, you buy. If it is substantially lower, you avoid or short. If they are roughly equal, you move on to the next opportunity. But if you look at price first, let us say you see the stock at $50 before calculating intrinsic value, your entire DCF analysis becomes an exercise in justification. If your initial impression is that $50 feels cheap based on some vague sense of the company's quality, you will unconsciously adjust your growth assumptions upward and your discount rate downward until your model produces an intrinsic value of, say, $70, thus confirming your anchored impression. If your initial impression is that $50 feels expensive, you will adjust assumptions in the opposite direction until your model confirms that impression. This is not valuation. This is confirmation bias layered on top of anchoring. The operational implementation requires discipline. I recommend using software or spreadsheets that do not automatically display stock prices. If you're using Bloomberg or FactSet, train yourself to navigate directly to financials without glancing at the price chart. If you're using free tools like Yahoo Finance, cover the price section of the screen until your analysis is complete. This sounds absurd. It sounds like you are playing games with yourself, but that is exactly the point. You are playing games with yourself because your System 1 is playing games with you. The only way to beat System 1 is with procedural discipline that prevents it from hijacking your analysis.
Epictetus taught that freedom comes from recognizing what is within your control and focusing exclusively on that. Your intrinsic valuation process is within your control. The current market price is not. It is the collective judgment of millions of participants. By purging anchors before analysis, you ensure that your valuation reflects your control, not the market's arbitrary reference points. Step 2. The first principles rebuild. Derive value from fundamentals, not from comparables. The second step in the Epictetus tactic addresses a subtle but destructive form of anchoring: comparable company valuation. Most investors do not calculate intrinsic value from first principles. They look at what similar companies are trading for and use those multiples as reference points. This is anchoring masquerading as analysis. When you value a company by saying it should trade at 15 times earnings because its peers trade at 15 times earnings, you are not valuing the company. You are anchoring to the peer group. But the peer group may be overvalued or undervalued. The peer group may have different growth rates, margins, or competitive positions. By anchoring to peers, you are importing their valuation, which may be irrational, into your own analysis. This is how entire sectors become overvalued. Everyone anchors to everyone else, and no one asks whether the underlying businesses justify the valuations. The first principles rebuild requires that you derive value exclusively from the specific company's fundamentals. You do not ask, what multiple do peers trade at? You ask, what cash flows will this specific business generate, and what are those cash flows worth today? This forces you to engage with the actual economics of the business, rather than with market sentiment about similar businesses. Here is the protocol. You build a 10-year cash flow projection for the company. Year by year, you estimate revenue growth based on unit volume growth and pricing power. You estimate operating margins based on cost structure and competitive dynamics. You calculate capital expenditures required to support growth. You project working capital changes. You sum free cash flows for the 10-year period. You estimate a terminal value based on a sustainable perpetual growth rate. You discount all cash flows back to present value using the company's weighted average cost of capital. The result is intrinsic equity value. You divide by shares outstanding. This is intrinsic value per share. This process is laborious. It requires judgment about growth rates, margins, and discount rates. But that is precisely the point. You are exercising judgment about the specific company's characteristics, not borrowing judgment from comparable companies whose characteristics may differ materially. When you are forced to explicitly forecast 10 years of cash flows, you cannot hide behind anchors. You must confront the reality of the business. Is it growing or shrinking? Are margins expanding or contracting? Is capital intensity increasing or decreasing? These are the questions that determine intrinsic value. Comparable multiples are not. Epictetus would recognize this as the distinction between opinion and knowledge. When you value a company based on peer multiples, you are adopting others' opinions. You do not know why peers trade at those multiples. You do not know whether those multiples are justified. You are accepting appearance, the market's pricing of peers, as reality. When you value a company from first principles, you are deriving knowledge from the company's actual characteristics. This is phantasia kataleptike, an impression based on reality rather than convention. The operational discipline is to ban relative valuation from your process until after you have completed absolute valuation. Do not look at relative valuation, PE ratios, PB ratios, or EV to EBITDA multiples for peers. These are anchors. They will contaminate your analysis. Only after you have calculated intrinsic value from discounted cash flows are you allowed to perform a sanity check by comparing your implied multiple to peers. If your DCF implies a PE of 30 and peers trade at 15, you must ask why. Maybe your growth assumptions are too optimistic. Maybe peers are undervalued. But you ask this question after the fact, as a check, not before the fact, as an anchor. Step 3. The scenario matrix. Replace single-point anchors with probability-weighted ranges. The third step in the Epictetus tactic addresses the false precision that anchoring encourages. When you anchor to a single number, this stock is worth $75, you create a target that your brain latches onto. But intrinsic value is not a point estimate, it is a probability distribution. Different assumptions about growth, margins, and discount rates produce different valuations. The scenario matrix forces you to replace single-point anchors with probability-weighted ranges that reflect the true uncertainty inherent in valuation. Here is the protocol. After you complete your base case DCF, you create two additional scenarios, a bull case and a bear case. In the bull case, you assume optimistic but plausible outcomes for key drivers. Revenue growth is at the high end of historical ranges. Margins expand due to operating leverage. The competitive environment remains favorable. You recalculate intrinsic value under these assumptions. In the bear case, you assume pessimistic but plausible outcomes. Growth slows due to market saturation. Margins compress due to competitive pressure. Reinvestment requirements increase. You recalculate intrinsic value under these assumptions. Now you have three values: bear case, base case, and bull case. Let us say they are $40, $60, and $90 respectively. You assign probabilities to each scenario based on your assessment of the likelihood. Perhaps you believe there's a 25% chance of the bear case, 50% chance of the base case, and 25% chance of the bull case. You calculate the probability-weighted intrinsic value, 0.25 times 40 plus 0.50 times 60 plus 0.25 times 90 equals $62.50. The psychological benefit is that you are no longer anchored to a single number. You have a distribution. When the market price is $55 and your base case is $60, your brain wants to anchor to 60 and conclude only 9% upside, not interesting. But when you consider the full distribution, you recognize that there's a 25% probability of a $90 outcome, a 64% upside, and the probability-weighted value of $62.50 still offers 13% upside to the current price of $55, with a substantial margin of safety provided by the bear case floor at $40. This is Stoic thinking applied to valuation. Epictetus taught that the wise person does not claim certainty about uncertain things. You cannot know with certainty what a company will grow, what margins it will achieve, or what competitors will do. Claiming a single-point intrinsic value of exactly $60 is pretending to knowledge you do not have. The scenario matrix acknowledges uncertainty explicitly and incorporates it into your decision framework. The operational implementation is to create a simple spreadsheet with 3 columns: bear, base, bull. For each column, you input your assumptions about revenue growth, operating margin, CapEx as a percentage of revenue, and discount rate. The spreadsheet calculates intrinsic value for each scenario. Below the scenarios, you input your probability assessments and calculate the weighted average. You review this matrix quarterly and update your probabilities as new information emerges. This prevents you from anchoring to outdated base cases when fundamentals change. Epictetus taught that attachment to specific outcomes causes suffering. When you anchor to a single intrinsic value, you are attaching to a specific outcome, the market reaching that value. The scenario matrix eliminates attachment by showing you a range of possible outcomes, allowing you to make decisions based on expected value rather than on hitting a specific target. Step 4. The blind reevaluation. Reassess intrinsic value without reference to your prior estimate. The fourth and final step in the Epictetus tactic addresses a particularly insidious form of anchoring to your own prior estimates. Once you have calculated an intrinsic value and written it down, that number becomes an anchor for all future reevaluations. When you revisit the position 6 months later, you do not recalculate from scratch. You look at your prior estimate and make incremental adjustments. This is anchoring to your past self. The blind reevaluation solves this by requiring you to periodically recalculate intrinsic value from first principles without referencing your prior estimate. Here is the protocol. Every 6 months, you take out a blank spreadsheet. You download the latest financial statements. You rebuild your DCF model without looking at your previous model. You make fresh assumptions about growth, margins, and discount rates based on current information and current industry conditions. Only after you have completed the new intrinsic value calculation do you compare it to your previous estimate.
If the two estimates are similar, you gain confidence that your valuation is stable and not driven by transient factors. If the two estimates diverge materially, you have uncovered new information or changed assumptions, and you must investigate why. Perhaps the company has acquired a new business line that changes the growth profile. Perhaps competitive dynamics have shifted. Perhaps interest rates have changed, affecting your discount rate. The divergence is diagnostic. It tells you where your thinking has evolved. The psychological power of the blind reevaluation is that it prevents incremental anchoring. When you adjust prior estimates, you make small tweaks. I will increase my growth assumption from 5% to 6% that feel rational but are actually anchored to your prior assumptions. The 5% was an anchor. The 6% is just a small adjustment from that anchor, not a fresh assessment. By rebuilding from scratch, you force yourself to justify every assumption as if you were analyzing the company for the first time. Epictetus taught that the philosopher must examine their judgments continuously, not assume that yesterday's judgments remain valid today. He wrote, "If you wish to make progress, abandon such reasonings as, if I neglect my affairs, I will have nothing to live on, and others of that kind. For such reasonings are a kind of trap, and when we are deceived by them, we seem to be doing something sensible." The same applies to investment judgments. If you neglect to reevaluate from first principles, reasoning, "My prior estimate was thorough, so small adjustments are sufficient," you are trapped by anchoring to your past self. You seem to be doing something sensible, updating incrementally, but you are actually perpetuating outdated anchors. The operational implementation is to schedule blind reevaluations every 6 months for all holdings. Mark your calendar. When the date arrives, you close all prior models and analyses. You open a blank file. You conduct the analysis as if you have never valued this company before. Only after completing the new valuation do you compare to the old. If you are managing a concentrated portfolio of 10 to 15 positions, this process takes significant time. Budget an entire day per position. This is not busy work. This is the only reliable method to prevent anchoring from calcifying your judgments into permanent errors. Now, let me answer the 10 most critical questions you have about beating the anchoring effect using the Epictetus tactic. You now have the complete 4-step framework for neutralizing anchoring and focusing on intrinsic value. But operational questions remain. Let me address the 10 questions I encounter most frequently from investors implementing the Epictetus tactic. Each answer will provide additional depth and connect the philosophy to practical execution. Question 1. How do I prevent my DCF assumptions from being unconsciously influenced by my knowledge of the current stock price? This is the central challenge of the anchor purge, and it requires radical honesty with yourself. The truth is that once you know the current price, you cannot unknow it. It will influence your assumptions at some level, even subconsciously. The solution is not to achieve perfect mental purity. That is impossible. The solution is to create procedural checks that detect when anchoring is influencing your assumptions. Here is the operational protocol. After you complete your DCF without looking at price, you write down your intrinsic value estimate with a date and signature. You then reveal the current market price. If your intrinsic value is within 10% of the market price, you must assume that anchoring influenced your model, even if you genuinely tried to avoid it. The reason is mathematical. The probability that your independent estimate would land within 10% of the market price is low. If it happens, it is more likely that you unconsciously calibrated your assumptions to produce a reasonable result close to market consensus. When this happens, you do not abandon your analysis. You perform a sensitivity analysis. You identify the 3 most subjective assumptions in your model, typically revenue growth, terminal growth rate, and discount rate. For each assumption, you adjust it by 10% in both directions and observe how intrinsic value changes. If small changes in assumptions produce large changes in intrinsic value, your model is highly sensitive and you need more certainty about those assumptions before committing capital. If intrinsic value is relatively stable across a range of assumptions, you have more confidence that your valuation is robust.
Epictetus would frame this as recognizing the limits of your prohairesis. You cannot directly control whether anchors influence your subconscious. What you can control is your commitment to testing your judgments through sensitivity analysis. This is the Stoic practice of epistemic humility, acknowledging that your impressions may be contaminated and subjecting them to rigorous scrutiny before assenting. Question 2. What if intrinsic value is inherently subjective, making it just as arbitrary an anchor as market price? This question confuses precision with arbitrariness. Intrinsic value is subjective in that it requires judgment about uncertain future outcomes, but it is not arbitrary. It is derived systematically from the economic characteristics of the business. Market price, by contrast, reflects collective sentiment that may have no relationship to fundamentals. These are not equivalent forms of uncertainty. Consider the distinction. When you estimate that a company will grow revenue at 8% annually, you are making a judgment based on historical growth rates, market size, competitive positioning, and management's capital allocation track record. Your estimate could be wrong, it is uncertain, but it is not arbitrary. It is constrained by observable facts. When a stock price moves from $50 to $70 because a celebrity investor tweets about it, that price change is arbitrary. It reflects sentiment, not fundamentals. The Epictetus tactic does not claim that intrinsic value can be calculated with precision. It claims that intrinsic value, imprecise as it may be, is a more reliable basis for decision-making than arbitrary price-based anchors. Epictetus distinguished between things that are up to us and things that are not up to us. The assumptions you input into your DCF model are up to you. You control them through research and judgment. The market price is not up to you. It is determined by millions of participants, most of whom are not analyzing fundamentals. The operational discipline is to make your subjectivity explicit. When you estimate growth rates, you write down why you chose that number. You cite historical data, industry reports, and competitive analysis. This creates an audit trail. 6 months later, when you reevaluate, you can assess whether your subjective judgments were reasonable given available information. This is accountability. Market prices have no such accountability. They move for reasons that are often impossible to determine. By grounding your decisions in explicit, documented assumptions about fundamentals, you create a system that learns and improves. Anchoring to market prices creates no such system. Question 3. In fast-moving markets or with rapidly evolving companies, is it practical to avoid looking at price before completing a full DCF analysis? Yes, and it is especially critical in fast-moving contexts. The faster the market moves and the more rapidly the company evolves, the more powerful anchoring becomes. When prices are volatile, your System 1 generates strong emotional reactions: fear when prices fall, greed when they rise. These emotions amplify anchoring. If you see a stock fall 20% in one day, your brain anchors to the pre-decline price and interprets the new price as cheap, even if the decline was justified by deteriorating fundamentals.
The anchor purge is most valuable precisely when it is most difficult. In fast-moving markets, you must resist the urge to check prices constantly. This requires discipline. I recommend establishing specific times, perhaps once per week, when you review prices and compare them to your intrinsic value estimates. Between those scheduled reviews, you do not look at prices. You focus on analyzing businesses. This is the Stoic practice of maintaining equanimity in chaos. Epictetus taught that external events, including market volatility, are not up to you. Your reaction to those events is up to you. By establishing a disciplined schedule for price reviews, you maintain control over your reaction instead of allowing volatility to control you. For rapidly evolving companies, think of early-stage technology firms where business models are shifting. The DCF framework must be adapted. You cannot project 10 years of cash flows with any confidence when the company may pivot its strategy next quarter. In these cases, you use scenario analysis more heavily. You model multiple paths the company could take: success in current market, expansion into adjacent markets, failure requiring restructuring. Each path has a probability and a valuation. Your intrinsic value is the probability-weighted average. This is more art than science, but it is still grounded in fundamentals: customer acquisition costs, lifetime values, unit economics, rather than in price-based anchors. The key insight is that uncertainty about fundamentals does not justify anchoring to price. Uncertainty about fundamentals justifies wider error bars around your intrinsic value estimate and smaller position sizes to reflect that uncertainty. But it does not justify substituting price-based heuristics for fundamental analysis. The Epictetus tactic applies with equal force to rapidly evolving companies. You simply acknowledge greater uncertainty in your scenario matrix. Question 4. How do I apply the first principles rebuild to sectors where peer comparisons are standard practice, like REITs or utilities? This question reveals a deep truth about relative valuation. It is not that relative valuation is always wrong, it is that relative valuation must come after absolute valuation, not before. In sectors like REITs or utilities, where regulatory constraints and capital structures make cash flows relatively predictable and comparable, peer multiples can provide useful context, but they must provide context to a fundamental valuation, not replace it. Here is the protocol for sectors where comparables are standard. You still begin with absolute valuation. For a REIT, you project property-level cash flows based on occupancy rates, rental escalations, and operating expenses. You subtract corporate overhead and interest expense. You project capital expenditures for maintenance and new development. You calculate free cash flow to equity and discount it at the cost of equity. This gives you intrinsic value per share from first principles. Only after you have completed this absolute valuation do you examine peer multiples, price to FFO, price to NAV, cap rates. You ask, if my DCF implies a price to FFO multiple of 12 and peers trade at 15, why? Perhaps your growth assumptions are too conservative. Perhaps you have underestimated occupancy improvements. Perhaps peers are overvalued. But you examine this question after establishing your fundamental anchor, not before. The psychological discipline here is critical. When you look at peer multiples first, your brain automatically anchors to the peer average. If peers trade at 15 times FFO, your DCF assumptions will unconsciously adjust to produce a valuation around 15 times FFO. You are not doing independent analysis. You are reverse engineering your assumptions to match the peer group. This is how sectors become systematically mispriced. Everyone anchors to everyone else, and no one asks whether the sector as a whole is rationally priced. Epictetus taught that the philosopher must think for themselves, not simply absorb conventional wisdom. In investment terms, this means your valuation must reflect your independent judgment about the business, not the market's collective judgment about similar businesses. Peer multiples represent the market's judgment. They may be wisdom or they may be madness. You cannot know unless you first establish an independent baseline through fundamental analysis. The operational implementation is to create a two-stage valuation process. Stage 1 is absolute valuation from DCF. You calculate intrinsic value and write it down. Stage 2 is relative context. You examine peer multiples and ask whether they suggest adjustments to your Stage 1 valuation. If there is a material divergence, you document the reasons and update your scenario matrix to reflect additional bull or bear cases. But Stage 1 always comes first. This sequence ensures that peers inform your valuation rather than determine it. Question 5. What if my intrinsic value estimate is wildly different from the market price? Does that mean the market is wrong or that my analysis is wrong? This is the question that separates contrarian investors from conformist investors. When your intrinsic value diverges materially from market price, one of three things is true. First, your analysis is wrong. You have made an error in assumptions, calculations, or logic. Second, the market is wrong. It is mispricing the security due to temporary sentiment, institutional constraints, or information asymmetry. Third, you both have access to different information that is material to valuation. The Epictetus tactic requires that you systematically evaluate all three possibilities before concluding anything. First, you perform an error check. You review your DCF model line by line. You verify your calculations. You examine your assumptions and ask whether they are supported by evidence or by wishful thinking. You seek out investment theses that contradict yours, short seller reports, bearish analyst research, and test whether they identify flaws in your logic. This is intellectual humility. You assume you could be wrong and actively search for evidence of error. If you complete the error check and remain confident in your analysis, you move to the second possibility, market mispricing. Here, you ask why the market might be wrong. Is there forced selling due to index rebalancing or fund redemptions? Is the company too small for institutional coverage? Is there temporary bad news that obscures long-term fundamentals? Is the company in a sector that is currently out of favor? These are all potential sources of temporary mispricing that create opportunity for patient investors. Third, you consider information asymmetry. Perhaps the market knows something you do not. Perhaps insider selling has accelerated. Perhaps customers are churning, but this is not yet visible in reported financials. Perhaps regulatory changes are imminent. You research these possibilities systematically. You check SEC filings for insider transactions. You read customer reviews in industry forums. You monitor regulatory developments. If you find evidence that the market has information you lack, you update your analysis. Epictetus would frame this as the distinction between opinion and knowledge. Your intrinsic value estimate is your opinion about what the business is worth. The market price is the aggregate opinion of all participants. Neither opinion is automatically knowledge. Knowledge comes from testing your opinion against reality, the actual cash-generating capacity of the business. If your opinion diverges from the market's opinion, you do not automatically assume you are right or wrong. You investigate. The operational discipline is to establish a divergence threshold. If your intrinsic value is within 20% of market price, the divergence is not actionable. It could simply reflect the uncertainty inherent in valuation. If your intrinsic value exceeds market price by more than 30% after you have performed a thorough error check, you have a potential buying opportunity. If market price exceeds your intrinsic value by more than 30%, you avoid or short. The threshold ensures that you only act on divergences large enough to compensate for the risk that your analysis contains errors. The Stoic insight is that you cannot control whether the market agrees with your valuation. Market agreement is outside your control. What you can control is the rigor of your process. If your process is sound, you have purged anchors, rebuilt from first principles, modeled scenarios, and performed blind reevaluations, then large divergences from market price are not threats, they are opportunities. You trust your process and patiently wait for the market to recognize the value you have identified. Question 6. How do I handle situations where I need to make quick decisions and do not have time for a full DCF analysis? This is a question about preparation versus reaction. The Epictetus tactic is designed for the former, not the latter. Epictetus taught that the philosopher prepares their mind in advance so that when crisis comes, they do not need to think. They simply execute pre-established principles. In investment terms, this means you do your deep work during periods of calm so that during periods of opportunity or stress, you are executing a prepared plan rather than making reactive decisions. Here is the operational framework. You maintain a watch list of companies you have already analyzed using the full Epictetus tactic. For each company on your watch list, you have calculated intrinsic value using the anchor purge, first principles rebuild, scenario matrix, and regular blind reevaluations. You have established buy prices, typically your bear case intrinsic value, and you have set alerts that notify you when the market price crosses those thresholds. When the alert triggers, you do not need to conduct a full DCF in real time. You have already done the work. You simply execute the predetermined buy if no material fundamental changes have occurred since your last reevaluation. For genuinely new opportunities that arise suddenly, special situations like spin-offs, bankruptcies, or activist campaigns, you must make a choice. Either you pass on the opportunity because you cannot conduct proper due diligence in the available time, or you size the position small enough that an error will not meaningfully damage your portfolio. A 2% position can be made with less analysis than a 10% position. This is position sizing as a function of analytical confidence. The less time you have for analysis, the smaller the position must be. Epictetus taught that freedom comes from accepting what you cannot do, rather than overextending yourself. You cannot do a proper DCF analysis in 1 hour. Trying to do so under time pressure guarantees that anchoring will hijack your process. You will glance at the price, form a quick impression, and then rationalize that impression with abbreviated analysis. This is not valuation. This is gambling with intellectual window dressing. The Stoic investor says, "I cannot properly analyze this opportunity in the time available. Therefore, I will either pass or I will size it so small that I can tolerate being wrong." This is not missing out. This is discipline. Over a career, the opportunities you pass because you cannot properly analyze them are vastly outnumbered by the opportunities that are properly analyzed and successfully exploited. The Epictetus tactic is not designed for day traders or momentum investors. It is designed for fundamental investors who make concentrated bets based on deep understanding. If you are trying to make quick decisions on inadequate information, you are in the wrong game. Question 7. Can I use the Epictetus tactic for macro investing or asset allocation, or does it only apply to individual security selection? The Epictetus tactic applies to any domain where anchoring distorts valuation. In macro investing and asset allocation, anchoring is pervasive. Investors anchor to historical average returns. Stocks have returned 9% annually, so I expect 9% going forward. They anchor to recent returns. Bonds lost money last year, so I'm reducing my bond allocation. They anchor to psychological round numbers. I will rebalance when my equity allocation reaches 65% instead of 60%. All of these are anchors that have no relationship to intrinsic value. For asset allocation specifically, intrinsic value translates to expected return based on current fundamentals. You do not ask, what has the stock market returned historically? You ask, given current valuations, current earnings growth expectations, and current interest rates, what return can I reasonably expect going forward? This is a first principles approach to asset allocation. Here is the protocol. For equities, you calculate the expected return as earnings yield plus expected real earnings growth plus expected inflation minus expected multiple contraction or expansion. If the S&P 500 is trading at a PE of 22, the earnings yield is 4.5%. If you expect real earnings growth of 2% and inflation of 3%, that is 9.5%. But if you expect the PE to revert from 22 to the long-term average of 16 over 10 years, that is approximately -3% annually. Your expected return is approximately 6.5%. For bonds, the expected return is approximately the current yield to maturity adjusted for expected default losses. If 10-year treasuries yield 4% and you expect 0 defaults, your expected return is 4%. You now compare the expected returns, 6.5% for equities versus 4% for bonds. The equity risk premium is 2.5%. You ask whether that premium is adequate compensation for the additional volatility and uncertainty of equities. This is intrinsic value thinking applied to asset allocation. The anchor purge applies by forcing you to ignore what the stock market did last year or what your portfolio target allocation was last decade. Those are anchors. You focus on what assets are worth today based on today's cash flow characteristics and today's opportunity cost. The first principles rebuild applies by requiring that you calculate expected returns from fundamentals rather than extrapolating historical averages. The scenario matrix applies by modeling different economic scenarios, recession, expansion, stagflation, and assigning probabilities. The blind reevaluation applies by recalculating expected returns quarterly without reference to your prior estimates. Epictetus taught that principles must be universally applicable. The principle distinguish appearance from reality applies to individual stocks, to asset classes, and to portfolio construction. In all cases, you are training your mind to see through anchor. For asset allocation specifically, intrinsic value translates to expected return based on current fundamentals. You do not ask, what has the stock market returned historically? You ask, given current valuations, current earnings growth expectations, and current interest rates, what return can I reasonably expect going forward? This is a first principles approach to asset allocation. Here is the protocol. For equities, you calculate the expected return as earnings yield plus expected real earnings growth plus expected inflation minus expected multiple contraction or expansion. If the S&P 500 is trading at a PE of 22, the earnings yield is 4.5%. If you expect real earnings growth of 2% and inflation of 3%, that is 9.5%. But if you expect the PE to revert from 22 to the long-term average of 16 over 10 years, that is approximately -3% annually. Your expected return is approximately 6.5%. For bonds, the expected return is approximately the current yield to maturity adjusted for expected default losses. If 10-year treasuries yield 4% and you expect 0 defaults, your expected return is 4%. You now compare the expected returns, 6.5% for equities versus 4% for bonds. The equity risk premium is 2.5%. You ask whether that premium is adequate compensation for the additional volatility and uncertainty of equities. This is intrinsic value thinking applied to asset allocation. The anchor purge applies by forcing you to ignore what the stock market did last year or what your portfolio target allocation was last decade. Those are anchors. You focus on what assets are worth today based on today's cash flow characteristics and today's opportunity cost. The first principles rebuild applies by requiring that you calculate expected returns from fundamentals rather than extrapolating historical averages. The scenario matrix applies by modeling different economic scenarios, recession, expansion, stagflation, and assigning probabilities. The blind reevaluation applies by recalculating expected returns quarterly without reference to your prior estimates. Epictetus taught that principles must be universally applicable. The principle distinguish appearance from reality applies to individual stocks, to asset classes, and to portfolio construction. In all cases, you are training your mind to see through anchors, historical prices, peer behavior, conventional wisdom, and focus on the fundamental economics that determine value. This is Stoic thinking scaled to portfolio management. Epictetus taught that you cannot control others' opinions. You can control the procedures and processes that structure how those opinions are formed. By introducing procedural discipline, you create an environment where intrinsic value thinking becomes the default rather than the exception. This is not manipulation. This is leadership. You are helping your colleagues make better decisions by designing a decision-making process that neutralizes cognitive biases. The operational implementation requires political capital. You must have credibility within the organization. You must present the procedural change as an enhancement, not a criticism of current practice. You cite the behavioral finance research on anchoring. You frame it as, let's make sure we are valuing businesses, not reacting to market prices. You volunteer to pilot the new process on your own recommendations first. You demonstrate value by showing that the process generates better decisions. Over time, the process becomes institutionalized and anchoring is systematically neutralized across the entire investment process. Question 9. How do I know when to update my intrinsic value estimate versus when to stick with my existing estimate and view market price changes as noise? This question addresses the balance between conviction and adaptability. Over-updating, changing your intrinsic value estimate every time the stock price moves or every time a new data point emerges, reintroduces anchoring through the back door. You are letting market volatility or noisy information dictate your valuation. Under-updating, refusing to revise your estimate even when material fundamental changes occur, is stubbornness masquerading as discipline. The Epictetus tactic provides clear criteria for when to update. You update your intrinsic value estimate when and only when you observe material changes in the fundamental drivers of value: revenue growth, operating margins, capital intensity, competitive positioning, or cost of capital. You do not update because the stock price moved. You do not update because an analyst changed their rating. You update when the business itself changes in ways that affect future cash flows. Here is the operational protocol. You maintain a valuation driver checklist for each holding. The checklist specifies the 3 to 5 variables that most materially affect intrinsic value. For a SaaS company, this might be annual recurring revenue growth rate, net dollar retention, Rule of 40, growth rate plus free cash flow margin, sales and marketing efficiency, customer acquisition cost payback period. Every quarter, when the company reports earnings, you update these metrics. If any metric changes by more than 20% from your assumption, you trigger a full intrinsic value update using the blind reevaluation protocol. The 20% threshold is not arbitrary. It reflects materiality. Small changes in individual metrics may offset each other. Large changes in individual metrics are likely to meaningfully affect aggregate intrinsic value. By establishing a quantitative threshold, you remove discretion and thus remove the temptation to update reactively based on price movements rather than fundamental changes. Epictetus distinguished between things that are up to us and not up to us. Fundamental business performance is not entirely up to us, but it is the thing we are trying to predict through analysis. Stock price is not up to us at all. It reflects the aggregate judgment of millions of participants. By updating only in response to fundamentals, you maintain focus on what is at least partially knowable through analysis. By ignoring price movements, you avoid chasing noise. The Stoic discipline is to treat intrinsic value as a hypothesis that you update only when new evidence emerges. Price movements are not evidence about the business, they are evidence about market sentiment. Earnings reports, customer metrics, competitive developments, these are evidence about the business. Your intrinsic value estimate should respond to business evidence, not to sentiment evidence. This distinction keeps your analysis anchored to reality rather than to appearance. Question 10. What happens when my intrinsic value estimate says sell, but I have held the position for years and do not want to trigger capital gains taxes? Is this a form of anchoring? Yes. This is anchoring to your tax basis, which is a particularly insidious form because it is rationalized as financially prudent. You tell yourself, I will wait until I have held for 1 year to get long-term capital gains treatment, or I will wait until next year when my income is lower and I am in a lower tax bracket. These may seem like rational tax planning, but if the fundamental reason to sell is urgent, the business is deteriorating, the valuation is egregiously expensive, then delaying for tax reasons is allowing an anchor, your tax basis, to override intrinsic value thinking. The Epictetus tactic requires that you separate the investment decision from the tax decision. The investment question is, what is this business worth, and should I own it at the current price? The tax question is, if the investment analysis says sell, what is the after-tax opportunity cost of selling now versus later? These are distinct questions requiring distinct frameworks. Here is the operational protocol. First, you complete your intrinsic value analysis without any consideration of taxes. You calculate intrinsic value, you compare to market price, you determine whether the position should be held or sold based purely on investment merits. Only after you have made this determination do you introduce tax considerations. If the investment analysis says sell, you calculate the after-tax proceeds from selling today. You calculate the after-tax proceeds from holding until you qualify for better tax treatment, adjusted for the probability that the price declines during the waiting period. If the expected after-tax value of immediate sale exceeds the expected after-tax value of delayed sale, you sell immediately. If delayed sale has higher expected value, you delay, but you set a specific date and commit to executing regardless of what happens to the price. Epictetus taught that we must distinguish between things that are genuinely within our control and things that are not. Your tax liability is partially within your control through timing strategies, but the future price of the stock is not within your control. If you hold a position that your analysis says you should sell purely to avoid taxes, you are making a bet that the stock will not decline by more than the tax you would owe. This is speculation, not tax planning. The deeper issue is psychological. Tax anchoring is often a rationalization for loss aversion or regret avoidance. You do not want to sell because selling crystallizes the fact that you should have sold earlier. You do not want to pay taxes because paying taxes feels like a loss, even though the tax is levied on a gain. These are emotional responses, not analytical ones. The Stoic investor recognizes these emotions as impressions that should not be assented to automatically. The operational discipline is to make tax planning explicit. You maintain a spreadsheet that shows current position value, tax basis, unrealized gain, tax owed on immediate sale, after-tax proceeds from immediate sale, date when better tax treatment becomes available, expected decline in price between now and then, expected after-tax value of delayed sale. You calculate the expected values and make the decision based on mathematics, not on the emotional pain of paying taxes. This is controlling what is controllable, your decision-making process, rather than allowing emotional responses to tax bills to override investment rationality. If you are getting actionable value from this documentary, I want you to take 10 seconds right now and subscribe to The Rational Investor. We publish content like this every single week. Systematic frameworks that connect ancient Stoic wisdom with modern behavioral finance. This is not theory. This is operational discipline for serious investors who understand that cognitive biases cost real money, and that the only sustainable edge is psychological mastery. Hit that subscribe button now, and you will never miss the training that could save you from the next anchoring-driven error that would have cost you thousands or millions of dollars over your investment career. Do it right now. We have covered substantial analytical territory in this documentary. Let me now synthesize the core lesson and give you the single most important implementation step that will determine whether the Epictetus tactic becomes a permanent part of your investment process or remains an interesting idea you forget under pressure. The anchoring effect is not a minor bias. It is a systematic distortion of judgment that affects every valuation decision you make. When you anchor to a purchase price, you confuse your entry point with intrinsic value. When you anchor to a 52-week high, you confuse past market sentiment with present business reality. When you anchor to analyst targets, you confuse others' opinions with independent analysis. When you anchor to historical valuation averages, you confuse past economic regimes with current fundamentals. All of these anchors share a common error. They substitute appearance for reality. Epictetus, teaching in the 1st century AD, provided the philosophical foundation for overcoming this error. He taught that human beings interact not with the world directly, but with impressions of the world. These impressions are not neutral. They are colored by cognitive shortcuts, emotional needs, and arbitrary reference points. The untrained mind assents to impressions automatically, treating appearance as reality. The trained Stoic mind pauses, examines the impression, and asks, is this impression based on the true nature of things, or is it based on irrelevant anchors? In investment terms, the true nature of things is intrinsic value, the present value of all future cash flows the business will generate. This value exists independent of what price you paid, what price the stock reached last year, or what price others believe it should reach. Intrinsic value is reality. Anchors are appearance. The Epictetus tactic trains your mind to distinguish between them with systematic rigor. The 4-step framework is immediately operational. The anchor purge eliminates reference points by requiring that you calculate intrinsic value before looking at market price, preventing contamination of your analysis. The first principles rebuild forces you to derive value from the specific business's fundamentals rather than from comparable company multiples that import others' potentially irrational valuations. The scenario matrix replaces single-point anchors with probability-weighted ranges that explicitly acknowledge uncertainty and prevent overconfidence in precise but illusory targets. The blind reevaluation prevents you from anchoring to your own prior estimates by requiring periodic full recalculations from scratch. This is not easy. Anchoring is hardwired into System 1 thinking. Your brain will generate anchored impressions automatically. The Epictetus tactic does not eliminate those impressions. It provides the procedural discipline to prevent you from assenting to them before they are tested against fundamental reality. This testing requires work, building DCF models, forecasting cash flows, stress testing assumptions. But this work is the only reliable path to accurate valuation. Everything else is anchoring, dressed up as analysis. The investors who implement this framework do not outperform because they are smarter or because they have better information. They outperform because they are more disciplined. They have trained themselves to see through cognitive illusions that trap less disciplined investors. They calculate intrinsic value from first principles. They update only when fundamentals change, not when prices move. They maintain conviction based on analysis, not on anchors. And over years and decades, this discipline compounds into materially superior returns. Epictetus taught that philosophy is useless unless it changes behavior. The same is true of investment frameworks. The Epictetus tactic is useless if you understand it intellectually, but fail to implement it operationally. The test of whether you have learned anything from this documentary is simple. What will you do differently tomorrow? Will you calculate intrinsic value before looking at price? Will you build your DCF from first principles rather than from peer multiples? Will you model scenarios rather than anchoring to single-point estimates? Will you schedule blind reevaluations? These are procedural questions, not philosophical questions. But they are the questions that separate investors who master their minds from investors who remain enslaved to cognitive biases. Epictetus taught that freedom comes from controlling what is within your power. Your valuation process is within your power. The anchors that bombard you daily, prices, targets, opinions, are not. Focus obsessively on the former, remain indifferent to the latter. This is Stoic investing, and it is the only sustainable path to compound wealth in markets that are informationally efficient but psychologically chaotic. If this documentary has transformed how you think about valuation and cognitive discipline, I need 3 specific commitments from you. First, subscribe to The Rational Investor immediately. We publish comprehensive documentaries every week, systematically connecting Stoic philosophy with behavioral finance. This is professional-grade training for serious investors who understand that the battle is won or lost in the mind, not in the market. Hit subscribe now so you never miss content that could prevent catastrophically expensive anchoring errors. Second, open a spreadsheet right now, not tomorrow, right now, and begin implementing the anchor purge on your next investment analysis. Do not look at the current price. Do not check analyst targets. Start with the financial statements. Build your DCF. Calculate intrinsic value. Write it down with a date and signature. Only then reveal the market price. This single act of discipline will inoculate you against the anchoring that has been sabotaging your valuations for your entire investment career. Do it before you close this video. Third, watch our documentary on Seneca and the premeditation of financial losses, where we explore how the Roman Stoics' practice of negative visualization builds psychological resilience against portfolio volatility and drawdowns. That documentary complements what you have learned today by showing you how to prepare your mind for adverse outcomes so that when they occur, you respond with rationality rather than panic. The link is in the description below. Watch it immediately. Remember, the market does not reward intelligence, it rewards discipline. The smartest analysts anchored to purchase prices underperform disciplined investors who calculate intrinsic value from first principles. You now have the framework. You now have the philosophy. You now have the operational steps. The only question remaining is whether you will implement them with consistency. Mastery does not come from understanding. Mastery comes from practice. Practice daily, practice ruthlessly. And over time, you will build not just wealth, but the cognitive serenity that allows you to see reality clearly while others remain trapped by appearance. Thank you for watching. I will see you in the next documentary. 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 Documentary.
All content provided by The Rational Investor is for educational and informational purposes only. It is based on academic principles in philosophy, psychology, and behavioral finance. We are not registered financial advisors. Nothing on this channel constitutes financial advice, investment recommendations, or an endorsement to buy or sell any security. Consult a qualified, registered financial professional before making any investment decisions. By watching our content, you agree to hold the rational investor harmless from any losses or damages resulting from your investment choices. If this approach to blending Stoic discipline with financial strategy resonates with you, I warmly invite you to join our community. Hit that subscribe button to get weekly documentaries that empower you to navigate markets with clarity and fortitude. For more on tackling cognitive biases, check out our playlist on Stoic investing principles, linked below. Let's keep building your portfolio strength together, one rational decision at a time.